Everybody, my name is Amin Reina, and I'm an investment coach and founder of Sage Investors, and I'm here to get you in the loop about what's going on in the whole world of investing. And right now, the big thing going on right now is happening in the bond market. Yields are going up, and it's a little bizarre because we've been kind of in a very low interest rate environment. If you go back a year ago from today, or right now, we are in a zone rarely where, especially in Canada and the U.S., where bond spreads, the spreads between short-term rates and long-term rates, were flat or almost inverted, and which usually is a trigger for an economic slowdown. And guess what? We've had an epic health crisis that has created a lot of chaos and a lot of economic malaise in the last year. So sure enough, the central banks jumped in and dropped rates to literally nothing and started going out and buying all kinds of assets to keep interest rates low. That's been the dynamic for the last year. And now all of a sudden we're starting to see the dynamics change in that bond yields. The bond market is basically signaling that yields should be going up. And so we've got 10-year, as I said, we've got 10-year US rates now at almost 1.2, 1.3%. Instead of yield curves flattening or inverting, we're now starting to see yield curves steepening. So what does that mean? It means essentially is the bond market is saying that economic growth is coming. It's on the horizon. It's happening. It might be happening right now. Perhaps because of the vaccines, and perhaps maybe we're starting to get to the other side of the pandemic, we might see a pickup in economic growth. We're starting to see a lot of inflationary kind of signals. Commodity prices, materials are going up. That has an upward pressure on pricing. And ultimately, things that are inflationary tend to push interest rates up high because risk premiums start going up high. And ultimately, if interest rates start going up, that is also basically a signal that bond stock prices might be a bit more inflated and could be set up for a bit of a pullback of some level. And that's kind of where the stock market, stock prices have been kind of like flat. And so I think that there's a lot of kind of pondering or meditation going on right now about which direction things are going. The stock prices have had like an epic run, and maybe this is the starting of a signal that we're seeing that things are going to just start tapering off or slowing down a bit. So you have this dichotomy where the bond market is pushing rates up, but then you have central banks who have basically gone out there and pounding the table saying we're not increasing rates anytime soon. And we're okay if there's inflation. We're okay if prices go up for goods and services. We're okay to let that run because we want to stimulate the economy. We want to get things going. And if we run inflation higher than we should, we're okay with that. So this is the tension right now, is like, who's right here? What's the right formula? Should we be jacking up rates? Should be rates being jacked up, or should they be staying low? In my case, artificially low. That's the dynamic that's in play right now. So what does that mean? Well, it means when I'm looking at stock prices, as I said, I'm pretty much out there saying my mindset right now is I think everything is overpriced. Pick any data point, pick any technical indicator. It's showing market stock prices are just way stupid high. And I've said before that, even though I think that, I'm still out there buying stocks, I'm still buying investing, but I'm following my playbook, which is basically to buy quality assets of companies selling quality goods and services. And when I buy them expecting them to drop, because if they drop, I'm happy to go in and buy more of it because these are quality assets. And that's the dynamic that's kind of in play right now. We're seeing tensions in the bond market. And the bond market tends to be a very good indicator of future economic and financial health indicators with respect to the markets and with respect to economic growth. So something to pay attention to, and I think people are starting to pay attention to it. It's having an impact on currencies now because the US dollar has been going up a little bit, because if there's more demand for yields go up, then people are going to gravitate to currencies that are going to generate a higher yield, because that's we've talked about TINA, There is no other alternative at this point, given the next to the zero interest rates that we're in. So that's the big thing I'm watching right now, and I'm keeping an eye on that, and let's see how that plays out. And we might be seeing some sort of setup for maybe a pullback in stocks. I don't know how violent. I have no idea how violent it, but suffice to say, you gotta stick. I'm sticking to the playbook that I've got. In other news, I sneezed about 10 minutes ago, and guess what? Bitcoin went up another 4 or 5%. It's now over 50,000. It's closing around 51,000. Again, no explanation. It's just a lot of Tina and a lot of FOMO out there, and it's just all and a lot of institutions that are getting into Bitcoin are getting into it pretty high rate. So if Bitcoin was all that, then why weren't they into it when it was like $6,000? A Bitcoin like a year ago. So there's that other sideshow going on. But right now I'm paying attention to bond yields. And it's interesting too also that I've noticed that junk bond yields are becoming even more interesting. Just to tell you the state of the dynamic of the markets, junk bond yields are very, very almost lower than investment grade type bonds. And it just tells you what the dynamic is, the demand for people to look for alternative the reach for alternative yield. People are getting into super high risk type bonds. Another interesting dynamic. Let's see what happens now. If interest rates if the bond market keeps pushing the treasuries up, it's going to be interesting to see what that dynamic is. So that's what I'm seeing right now. Hopefully to get you, I've caught you up a little bit of what, getting you in the loop. If you're interested in following me, you can follow me on Twitter. My handle is @SageInvestors, or you can learn a little bit more about what I'm doing as an investment coach through my website, sageinvestors.ca. So that's another episode of In the Loop. Take it easy, stay safe, good luck, safe investing, happy investing. Cheers.